John Higgins, Mortgage One. Happy Monday. So we came through a pretty big news week last week as far as the economy goes. We had the Fed meeting. Of course, they raised interest rates by 0.25%. I think that was to be expected. And it looks like they're going to pause here for a bit. Hopefully, this will be the last rate hike as we head forward. And then we had another jobs number come out. A bit of a mixed bag on that. The headline number, at least for the previous month, was great. It was well over 200,000 again. There were some revisions on the prior months that kind of brought that overall number down a bit. So we'll see. The economy seems to be chugging along quite nicely. Inflation is still the number one enemy of interest rates. And as we've mentioned before, inflation's been a little sticky, stubborn, and it's not coming down quite as quickly as maybe the market had hoped. But I'm going to show you a little chart on what we're up against as far as interest rates. And as you can see, this number right around 3.3% on the 10-year Treasury has been really tough resistance. We've bounced off that and bounced higher many times, and that's happened in the last week or two as well. The volatility in the market has been great. So every day, our interest rates usually have quite a bit of change, let's say hour to hour and throughout the day. And that's not necessarily normal, but this is not necessarily a normal time. We're coming off ultra low rates during the pandemic. We've seen inflation fire up and rise to levels that we haven't seen since the 80s. And so there's a lot going on in the market that has given interest rates a bit of a pause. So until we break below comfortably this kind of 330 number on the 10-year Treasury, our rates are stuck in a band here. And each time that we've hit newer lows, we've bounced off those and headed back up. So we're at 350 today. That keeps our mortgage interest rates, again, between 6.5% and 7%, and they've been there for quite some time. As you can see, we've had more runs higher than we've had lower, unfortunately. But, as we see how the Fed's, huge increases in their Fed funds rate last summer and into the fall, as we see how they're going to impact the economy, we'll get a little clearer indication of what's going on. But for the moment, nothing to write home about as far as better rates. So hope you're having a great week. We'll catch you next week with another update. Thanks.